right, everybody. Welcome to another episode of the Alternative Investor Mastermind. Have a great guest today, Tom Dunkel. I've known Tom probably almost 15 years. We've done business across a couple different real estate asset classes. So really excited to have Tom on to talk about their venture in self-storage. Tom, welcome to the show.
Hey, Jack, my friend. It's great to be with you. And it was fun spending a couple of days with you in Miami recently.
Yeah, that was it was a great time. I had a couple small world moments, and you were certainly the biggest one of just kind of great minds thinking alike and reconnecting at these events. So why don't you tell everybody a little bit about your background, and you can kind of go into how we knew each other back in the day as well, and what you're up to now.
Yeah, sure. I'll try to keep it brief. I'm 54 now, so my history is getting longer and longer, so I can go on a little too long sometimes. But I was a corporate guy that had my MBA in finance and tax, and so I got into mergers and acquisitions and capital raising, corporate finance when I was in the corporate world. But I always wanted to do something on my own. And so 2006, my timing wasn't great, but I ended up jumping out of corporate life and going into entrepreneurial life, into real estate. And of course, here I thought, things were going to be easy. I've got an MBA from a great school. I had training from some fantastic people. I cut my teeth doing deals. And so I was like, this is, no problem. I'm going to be able to rock and roll my own business. It's going to be great. And then, I proceeded to get my ass kicked for the next few years as the world kind of crumbled through the real estate crisis. So I was like, okay, this is not going to be easy. I better start getting around the right people and learning and, really, tightening things up, because I didn't have at the time what I needed to make it happen. But, fast forward, here we are 16, going on 17 years later. I ended up going into the distressed mortgage note business, Jack, which where you and I initially connected. I partnered up with Joe Downs, and we started a company called US Mortgage Resolution, which still exists today. We've purchased going on, got to be going on, 900 million or so of distressed second mortgages, unpaid principal balance. We've raised a ton of money in that business. We've made good money in that business, but it was always very lumpy. And so along the way, we were looking at different things to help us kind of smooth out our business and our cash flow, because from one year to the next, we could have these wild swings in income and not really sure like where the next dollar was going to come from. So we did look at doing like some residential fix and flips. We had a hard money lending company. Actually, we tried to do that twice and failed both times. We had a title company for a little while. That didn't quite work out. We did start picking up some vacation rentals and Airbnbs, and those were really hot during the COVID time. And that portfolio still exists. But what we've really fallen in love with the last few years is self-storage. We started looking at storage maybe 2017, 2018 timeframe. But having, had some experience at that point in building a business and growing a business, we didn't jump right into it. So we went out and we got educated. We joined a mastermind group for self-storage, got ourselves around some of the best and brightest in the country. And then we started putting our team together, because Joe and I have pretty solid, finance and deal, backgrounds, underwriting, that kind of thing. But we weren't great at kind of the front end, filling the funnel, reaching out to these storage owners. So that's where our partner, Tim Kane, came in, because that's where his expertise lies. So we partnered up with Tim. And then the last piece of the puzzle was operations. We didn't really know how to operate a self-storage facility once we bought it. So we brought in Catherine East, who's an expert in the self-storage operations and management space for 16 years. And so we made her part of our team. And so that gave us the confidence, Jack, to then be able to really go out of the marketplace and make realistic offers. Because up to that point, we were making like these low ball offers that, thank God none of them got accepted, because we would have been like, what do we do now? But since we got the team together, we were able to make like realistic offers. And so we bought our first facility in 2020. We were able to quickly add value to that facility and exit it 18 months later. Then we bought our second facility in January of 2021, and we proceeded to buy 3 more that year. We've purchased 4 so far in 2022. We actually have 4 in the pipeline to close before the end of the year. So we're really going to be cranking. But we're just really excited about our team and where we're at in the self-storage industry right now.
Well, kudos to you for I won't say making a pivot, but making an expansion, and that's something that I've done and I've talked a lot about over the last couple of years. Because I still get calls from people in the note industry, asking me if I have loans available, and it seems like a lot of people, at least before the recent moves in interest rates, I mean, there just wasn't a lot of inventory, or the inventory there was extremely lumpy. And pricing, at least, I came from the institutional side of things by the end of my tenure in pricing. I mean, performing loans are pricing at close to par before interest rates moved. So it was getting very tough for a non-institutional investor to really only focus 100% on the distressed mortgage business. So kudos to you for that. And I'm excited for you guys. You mentioned value add. Value add is, on the multifamily space, which I'm more heavily involved in, is usually renovating apartments, raising rents, lowering expenses. What in the storage, what is value add in self-storage?
Sure. Good question. And it does differ a little bit from multifamily. And just a little asterisk there is that I've actually been a passive investor in multifamily deals since 2013. So I know that space pretty well. But yeah, you hit the nail on the head, Jack. I mean, in the multifamily space, you're changing out, the Formica for the granite, you're changing out the lighting package, doing those kinds of cosmetic upgrades, et cetera. Storage is different. So, at the end of the day, we have metal boxes with concrete floors and roll-up doors. So, when we talk about value add, it's really mostly around the operations of the facility, because our turnaround process is pretty much done with a broom. So, when someone leaves a unit, we're able to go in there and if they did it right, and of course they don't always do it right, we'll be able to just sweep out that unit and get it back up for rent. Sometimes that same day, especially if it's a market where there's high demand. We could have a unit, emptied out in the morning and rented that afternoon. So there's definitely a higher velocity to the turnaround process in storage, which adds to our value add there. But you'd be surprised how low some of the rates are that some of these mom and pop storage facilities are charging. We're about to close on a deal next month where the owner is 39% below market with his rates. And he's aware that he's below market, but he's 83 years old. He knows most of his customers. He doesn't want to piss them off. He likes to spend his time at the golf course, not, marketing and trying to, get new customers into his facility. And he's happy with the amount of money coming in every month. It's kind of mailbox money, and he's got it pretty well dialed in at this point because he knows what his, taxes, insurance, maintenance, utilities, et cetera. He knows what those are month to month. So he's making the money he wants to make, rock the boat. So meanwhile, especially, during COVID, storage became very, very popular as a lot of families had to turn their spare bedroom into an office. There's a lot of drivers pushing up the rents in many, many, many markets. And so meanwhile, rents are going up like this and he's down here. Doesn't take too long for him to be way out of line as far as where the market is. So that's, Jack, probably our biggest value add. And again, it's not rocket science, it doesn't take a lot of research and analysis, even though we do that with a fine tooth comb in the markets where we are. It's just something that as a professional organization, that's what we do. We're not afraid to have a little bit of turnover in the units. We're not afraid to, really kind of push the envelope there so that we are at or near the top of the market with our rates.
Yeah, I think there's a saying, if you have 100% occupancy, your rents are probably too low. That goes for multi and storage.
Yeah, exactly. And hotels and airplanes. Yeah, it's all that. Yeah. So if we have any, if we're totally full, we're not charging enough for sure.
Exactly. So, self-storage had a reputation. Well, even after 2008, it was really one of the most recession-resistant classes. In 2008, people were losing their houses. They needed to take their stuff and put it into storage. So, it's largely been resilient to, pretty much every crisis I can remember since I've been around. What can go wrong, and what do you guys do to, when you're underwriting? Like, what are some pitfalls you look for, or things you try to avoid?
Yeah, sure. And just to highlight what you just said about the resiliency, I mean, for the past 40 years, storage occupancy across the country has kind of gently meandered between like 80 and 90%. So it really generally is a very consistent income generating asset class for sure. But one of the things we do when we're looking at a facility is as I mentioned a few minutes ago, we do really dial into the market, because that's one thing that can really send your facility in a bad way, is going to be if there's new storage facility coming online. Like if you didn't know that Public Storage or Extra Space or CubeSmart, one of those big REITs, is putting in 120,000 square foot, brand new shiny facility in your market, that is something that can really suck a lot of the demand out of the market and away from your facility. So we certainly make sure to look at that, and we do have databases and things we subscribe to so we can make sure we see like what is the pipeline of developments looking like. So we want to make sure we're steering clear of a market where it either is oversupplied or it might become oversupplied. On the flip side, we look at things like housing starts. So maybe if the market is kind of at equilibrium right now, but there aren't any storage facilities coming online, but there are a ton of multifamily or other residential projects coming online in that 1, 3, and 5 mile radius, then we look at that as a really a strong point and something that points to a deal that could work out really, really well. So of course we're looking in southeastern United States where the demographics are just, people are moving there, populations are growing, jobs are growing, big infrastructure investments going in the southeast. So we're finding some really nice looking markets down there.
And from what I recall, there's a pretty high percentage of mom and pop owners that are the typical sellers. Is that correct?
Oh, 100%. Yeah, that's one of the things we really like about storage is, most people think that the big guys, Public Storage, Extra Space, CubeSmart, that they are really the dominant forces in the market, but they really aren't. They control about 25, 26, 27% of the overall market. And then there's another layer of kind of the larger regional and more sophisticated players, but 60+% of the market is still moms and pops that are just like, they have 1, maybe 2 locations. And again, they're not really running it like a business. It's kind of like a side thing. They get their mailbox money and they're not really pushing rents or doing marketing. They're not on Google. A lot of them don't have websites. So that's one of the things we're really excited about as we continue to grow. We have some lofty goals here moving forward. Is there are a lot of moms and pops out there that where we can buy their facility and create a lot of value.
So how does someone get involved? I have a lot of conversations with I think a vast majority of investors, they either think just buy a REIT or just the stock market and traditional investments, or they have to go in and buy a single family house themselves, or they think they can do it. It's not that difficult. You end up creating yourself. You want to do it for passive income, and you end up creating a job that ends up harder than your regular job. So how does somebody get involved passively in buying a multi-million-dollar storage facility?
Yeah, that's a great question, and it's certainly part of our mission is to get out there and help passive investors create wealth for them. But yeah, you're right. It's if you're out there as a real estate investor, you're trying to buy a self-storage facility. I mean, it is super competitive. Our own internal acquisition program is really robust. We use virtual assistants who are calling all the facilities in our markets. We're, doing direct mail, so we have a whole pretty sophisticated system. So if a single investor is going up against Belrose, not like we're the biggest, baddest in the market, but we have a solid acquisition program, and then it goes to underwriting. We have a whole sophisticated underwriting program, and we have lenders lined up and equity investors lined up. So, I think in that regard, we certainly have a competitive advantage over like a single real estate investor. So what those folks should do is they should look for an experienced sponsor like Belrose Storage Group. And that's really what we're here to do. They actually can't see it, but on my wall here in my office, and everybody at Belrose on the wall in their office, we have our company purpose on there, and just it's pretty long, but the the gist of it is that we want to touch a lot of people. We want our internal employees to grow and be awesome and very well financially educated and financially well off people. We also want everyone else that we touch to be, financially well off, and we want them to use our expertise to help them reach their financial freedom goals. So, we talk a lot about security and income and growth of the offerings that we provide. Of course, it's a real asset, right? So it provides security for folks who are maybe concerned about the upcoming economy. What's that going to look like? I lived through the internet bubble. So some of those companies, crypto is kind of a little bit of a flashback to me to the internet bubble era, where there's just so much hype around it, but there's no there. And so it makes me a little concerned about all the folks that are flocking, to try to make a quick buck in crypto. But we offer hard assets, and then these assets are throwing off income, right? So our cash flow payments to our investors can be 6, 8, 10% annualized each year, and then growth, right? Everybody knows that real estate goes up over time. There might be bumps in the road from time to time, but I'll take those bumps in the road over the Wall Street, casino bumps in the road any day of the week. So we take pride in putting these great offerings out to our investor community, and we're trying actively to grow that community. It's really one of our primary focuses right now, which is why, Jack, we've joined the Raise Masters group. We want to get out there and, really help to build our list and get the investors in that we can really help out. So we have these great, fully vetted, fully underwritten offerings that we put out from time to time. And it makes us feel good when our investors come back. They come back deal after deal. They'll bring more money, they'll bring their friends. And that's real great evidence that we're doing a good job for our investors.
Yeah, absolutely. What's great about this business is I say pretty often, real estate's a team sport. Some may say, we're kind of competing, but we're not in a self-storage business, but we're in an alternative investment business. But what's great is we also run a diversified fund, and our fund is the type of fund that, will invest in your types of offerings. So I'd say if someone's looking for specifically a storage operator, great. You guys are great. I highly recommend you guys. And if you want a broader exposure to multifamily and storage and other asset classes, you could actually invest through JCAM, which then in turn, allocates money to your fund as well as some other multifamily and alternative assets. So it's a great way to create win-win between our groups.
Yeah, 100%. Yeah, it's great. We just whether it's directly one of our investors or through one of your funds, we just want to help people honestly get out of Wall Street. And a little bit more about my history is that I used to work for publicly traded companies. I worked for 3 publicly traded companies in their finance organizations. And in fact, at a couple of those companies, I was in charge of writing the financial analysis that went into the quarterly and the annual reports. And so I had to describe what was going on in the company in, very plain terms. And, I would try to do that best I could, but I have to tell you that, and this is horrible to say, but when I would turn in my draft, like to the chief financial officer and then the chief executive officer for them to review it, they would always like spin it, make it sound, maybe better, or they would actually like try to confuse, things and make it, sound like it was just incomprehensible. And so investors, of course, can't make any sense of what ultimately, was published. And that always made me feel like, what the heck are we doing? That always made me feel bad. And not only that, by the time a retail investor even gets that information, it's 2-3 months old, and all the professionals, they already have that information. If the company's followed by any Wall Street analysts, so it's very uneven playing field for retail investors. So that was one of the reasons I just really wanted to get out and I felt I could do a better job as an alternative investing, expert, if you will, for those folks that are truly looking to build wealth and protect their wealth and, get some passive income going.
Yeah, absolutely. That was great. I'm glad you did. We're in the fourth quarter here of 2022, and we should talk about taxes as well, because I think it's the one thing we hadn't touched on yet. The taxes are way more advantageous in private real estate offerings and syndications than they are for REITs, especially. I was trying to Google what the average yield. I think is there a publicly traded REIT for the storage industry that you know of? Or I know
there's sure. Yeah. Public storage, Extra Space, and CubeSmart are the big publicly traded REITs out there.
Yeah. And I think, if you're a high earning professional, those REITs are actually not qualified dividends. So I believe, and again, this is not tax advice, but I'd owned some in very small quantities myself over time, and they get taxed at, I believe, 29.6%, because the REITs aren't first taxed at the corporate level. It passes through, and they're taxed it's basically ordinary income with a small discount. So I think they say you're getting a 5 or 6% dividend, you're really losing a third of that to taxes. How do things work on syndications when you actually own a piece of the syndication and the property itself through the syndication?
Yeah, sure. It is a huge advantage to these kind of private real estate partnerships. What we do is we have a couple classes of membership interests, as not to get too complicated, but the folks that are using self-directed qualified money from their either self-directed IRA or their self-directed 401k, they're not able to really take advantage of the taxes and specifically the depreciation deduction. So we have another class of shares, which is for investors that are using taxable accounts, and they are able to get the depreciation deductions. And so what that boils down to for an investor, and this is one of the things I love when I get my K1s, like for my multifamily deals or whatever, the K1s we send out for our self-storage deals, is, on the top, it'll say, your net income or your real estate earnings could be negative, but you look down the other column, it shows you your distributions, and that can be, big positive number. So in other words, you're getting cash, but you're paying taxes on a much lower amount, or it might even be a negative amount. So that's one of the beauties of investing in commercial real estate or lots of other kinds of real estate. Uncle Sam wants investors in real estate, and there are incentives in place to get investment dollars in the real estate. And that's a big one. And the other thing is accelerated depreciation. So there are different components, right? Like to a storage facility, it's not just one big facility. It can be broken down into its own little pieces, like the doors or the walls or the office, or, all these different things have their own depreciation schedules. And we can hire a professional to come in and do a cost segregation study. And they can tell us, oh yeah, that's not a 29-year asset, that's a 7-year asset. So you have 7 years to depreciate that, which of course accelerates that depreciation. And some things, again, this is the government is incentivizing this kind of investment. Some things are even available for immediate depreciation, which you get a huge bonus depreciation. And so it really helps to drive that top number on your K1, even lower or even negative. So it's definitely a big advantage that I think a lot of investors don't quite understand and sometimes overlook. They should talk to their CPAs and get the proper information about that. It's a big advantage.
Absolutely. As a fellow note investor too, and I know we've got hopefully a lot of our fellow colleagues that we knew through the years are listening to this. I'd been a real estate professional prior, and then after 2008, pivoting into Wall Street, I'd somewhat forgot about the tax benefits, and quickly remembered them when I started paying tax in New York. And I know you've had a couple of years where you had to stroke the government probably a bigger check than you would have liked.
Oh yeah, 100%. Yeah, that's tough on the distressed mortgage debt side because that interest income is typically ordinary. So yeah, that's rough. Which is again another reason why we just are really enjoying the self-storage space.
Yeah, I think it's something for the note investors listening. It's something you should definitely expand into. There's room for continuing to do the distressed loan business as opportunities present themselves. But we really, everyone should be more diverse and have multiple streams of income. And with inflation, it's good to have assets that you could have smart leverage on as well, because sometimes it's in an inflationary environment, it's good to also be a debtor in addition to owning debt. So everybody should take a deeper look at the self-storage space. Tom, do you have resources available? Is there an ebook or a guide or something for passive investors?
Yeah, for sure. If folks would go to our website, which is belrosestoragegroup.com, hopefully Jackie can put that in the show notes. We actually have a resource there. We're getting ready to revamp it and do an updated version of it, but we call it Safe Investing, and it's really a due diligence framework for passive investors to really break down a lot of the barriers that they run into to getting into alternative assets, like multifamily, self-storage, lending, et cetera. And SAFE is an acronym. It's S stands for sponsor. So the book has all kinds of questions you need to ask about your sponsor. A is for asset. What is it that you're actually investing in? Again, back to the crypto and the internet bubble. I don't think a lot of those folks really understood what they are investing in, but self-storage, multifamily, I mean, those are pretty easy to understand. F is for the financials. What are the projections? Are they reasonable? That sort of thing. And then E is exit. How do you get out of this thing, right? You can't go to schwab.com and click and sell your position in a Belrose Storage Group deal. You have to be comfortable as an investor knowing that your money's going to be tied up for a couple, 2, 3, 4, 5 years, depending on which deal you invest in. So that's a resource that's available. And really where that came from, Jack, is kind of my personal experience over the years, having been an accredited investor since 2006. I've had the ups and downs. I've made the mistakes. I've made some good decisions and been in some really good deals, but I've also been in bad deals with bad sponsors. I've lost money. So I wanted to put this resource together so that someone who's busy, a doctor, a lawyer, engineer, who wants to get into something passive and an alternative investment, but they just don't know how. I think it gives them a due diligence framework to say, okay, here are the questions you need to be asking. And if at any point, you get an answer from your sponsor or you do some research and it starts to not feel right, just forget about that deal. Move on to the next one. There's always another deal to find out there. So, and in addition, at our website, folks can sign up on our investor portal, and that's where all the good stuff happens. That's where we post our offerings. That's where the private placement memorandum is, and the investor deck, and all of those documents. And it's also where our investors can drop in their banking information. They can get actually our distributions direct deposited into their account. That's where our tax documents live, so they can share those documents with their CPAs. But our investors seem to really like the portal. It's a very handy resource, and keeps everything kind of in one place.
Yeah, absolutely. It's amazing with the technology now. I remember, 10, 15 years ago, well, really before they changed the rules, it was really tough to advertise. It was kind of risky to run a fund unless you were, in a country club and had enough rich friends that you could, advertise a deal without really advertising a deal. But
right.
It's it's really, it's really expanded from just what I'd call country club deals to, deals that the average, the average accredited investor can, really get exposure. And, I think a majority of people are underexposed to alternative assets. And I hesitate to even call one of my other guests on a prior podcast said he said he takes exception to real estate being called an alternative asset because it's really the original asset.
It's so funny, Jack. I say the exact same thing, and I was just about to say that. I was just about to get on my soapbox because, I mean, really, real estate is an alternative asset. Lending is an alternative asset. I mean, these things go back to biblical times, so it's ridiculous. What's really alternative are, options and stocks and all, crypto. I mean, talk about alternative crypto. I mean, all of that stuff to me is alternative and derived, from, the financial engineering that goes on at these publicly traded companies. It's crazy.
Yeah, absolutely. Before we finish up, I got to ask, storage wars or auctions, does that happen in any of the markets you're in? And can we get a YouTube video of?
Yeah, no, I mean, look, there's certainly plenty of fun stories. Like our operations expert, Catherine East, like she's got amazing stories to share about her experience. But no, that's all just made for TV stuff. Our auctions, everything's online now. So you just have to go to the auction website and you can buy, somebody's junk that they didn't pay to store. So but no, it's not as dramatic as all that.
Gotcha. With that, thanks for coming on one more time. Just give us your website and any social media you wanted to promote. We'll certainly put it in the show notes as well.
Sure. Yeah. Thanks again, Jack. Yeah. I'm Tom Dunkel. I'm the Chief Investment Officer at Belrose Storage Group.com. And it's B as in boy, ELROSE storagegroup.com. And there you can see all the backgrounds, bios of our awesome team. I'm really super proud of the team that we put together. But yeah, that's the best way to reach me is it would be through there. And I'd love to, field any questions that you have out there that, might have popped up from our discussion today. I'm always happy to, jump on a call or trade an email, what have you. So reach out.
Yeah, that sounds great. I look forward to chatting again. I mean, we can talk shop all the time, especially as, as this economy shifts and stuff. I'm sure there'll be more to talk about. I'm everyone who's listening to please subscribe to the podcast on your platform of choice, Spotify, iTunes. We also do post these on YouTube as well. So please subscribe, give us a like, give us a review, and tune in again for the next episode. Thanks, everybody.
That's all for this episode of Alternative Investor Mastermind. Now that you know the many alternative opportunities out there all up for the taking, you can finally become ultra connected and ultra wealthy. Get more valuable advice from the experts by subscribing to the show at AlternativeInvestorMastermind.com. Become a winner in the world of passive investing today in alternative investment strategies. Thank you for joining us. Until next time.